Welcome back, ladies and gentlemen. So good to have you with us. This first story really reflects the rapid rise of, custom tailored products designed for the older homeowner, and they're being launched by reverse mortgage companies, even though they don't function in the traditional way that a reverse mortgage does. And such is the latest with HighTechLending's new Equity Select. And let's go to Housing Wire's Reverse Mortgage Daily to learn a little bit more, and then to HighTechLending's website. This loan actually debuted last month in September as a first lien position HELOC, and they can set their payments as low as 1% of the annualized loan balance with a cap, and any unpaid interest that's accrued to the loan balance will be settled when the home is sold or through a final balloon payment that doesn't exceed the property's value. So what is the term of this loan? Well, it's actually longer than your standard mortgage. The loan carries a 40-year term and requires borrowers to draw at least 50% of the credit line, or $75,000, whichever is greater, during that 7-year draw period. And there's no recasting of payments for the life of the loan. And that, again, is a key feature for any loan designed specifically for older homeowners. You want to avoid payment shock at all costs because they're typically on a fixed income. So a traditional HELOC, we'll get into that in a moment, and the precarious position it leaves many retirees in. CEO and President David Peskin, who purchased a stake in HighTechLending in early 2024, said, "People want to make payments like credit cards, but there are no products out there that are really custom designed for older homeowners to access the equity and make payments that's comfortable for them." Adding that this product allows them to make home improvements, pay off debt, help grandkids, or whatever they want. With taxes and insurance increasing, it helps cover all that as well. It's a piece of the puzzle that was missing for us. Innovative products such as Equity Select are very different than your traditional HELOC, not only in how payments are made or structured, but in how they're underwritten. In other words, how does that homeowner qualify? And how does Equity Select stand apart from your traditional HELOC's qualifications? Equity Select targets retirees or soon-to-be retirees seeking to manage cash flow and remain in their homes without resorting to high-interest credit cards or interest-only short-term HELOCs. Peskin put it this way: if you have a good asset to put a lien against, you're less concerned about cash flows. You obviously want cash flows, so we designed the loan to value based on the age of the borrower and their life expectancy. Unlike a HELOC or a traditional 30-year fixed-rate mortgage, this particular product, Equity Select, is not looking so much at income or income to debt ratios, but at the borrower's age and, of course, the asset backing the loan. So the younger they are, they're going to get a little less money, similar that you would find in a HELOC, and the older they are, they'll have less time for that balance to increase. By the way, a full appraisal is required on this loan, which is good. It helps protect the lender and the investors, and it's now being offered in Arizona, California, Colorado, Florida, New Jersey, Oregon, and Utah, and they have 6 or 7 additional states that are expected to be online by the end of this year. And the second lien version is also slated for release in 2026, probably January. So we'll be watching for that and keeping you abreast of all the latest developments when it comes to innovation and senior lending products. And HighTechLending and American Senior are just one of the latest, and it looks like they have a winner on their hands. This week, we bring you our monthly installment of Reverse Market Insights Market Minute. That's where we have all the latest trends in HECM originations and much more. And for that, we bring back John McCue from RMI. John, good to have you with us. I know that we're in the midst of a government shutdown. Likely we still will be when this airs. But what can you tell us about the recent trends in HECM lending?
Hey, thanks, Shannon, for having me come back again this month. Really appreciate it. Kind of in the same spot we've been for the last month or two, as far as as far as data is from HUD and FHA. Federal government is still shut down, so we're not really getting any of that. So let's go ahead and start with just talking about where we've been seeing rates going, in particular the 10-year CMT. This is actually a graph that I showed last month, kind of ending up through August, and we were starting to see rates drop and then rates go up and rates starting to come back down again. But from there, from August through September into October here, we just kind of see them continuing to drop. So that's been fantastic. We'll see where those continue to go. I hopefully they don't go back up, but they've been going down. That's been really nice to see. We don't have any new case number assignments, just like we spoke about just a minute ago. We don't have any new data, but what we can see is, when we start looking at September endorsements, they did go up. So they did go up 7.2% in August to 2,211. You really have to imagine that a lot of that has to do with those rates coming back down. We kind of got out of the summer funk, people coming back from vacations, things like that. 6 of the 10 regions added volume on the month. Southwest jumped 19.7% to 219 loans. Rocky Mountain rose 13.9% to 189 loans. We had the Southeast Caribbean, they added 10% to 482 loans. And the Mid-Atlantic was actually flat month over month. Ironically, as we look at the top 10 lenders, it pretty much mirrored exactly what the regions did as well. So, six of the top 10 lenders were up in August, with one of those being flat in addition. Guild recovered by 81.6% to 69 loans. South River was up 44% with 78 loans, and Longbridge was up over just 19% with 365 loans. So, again, we've seen these, I guess, and the one flat one here is the Good Life TMAC. They stayed flat at 103 loans. But the big piece here is we've been seeing rates go down. We're starting to see numbers go up both by regions and the major lenders out there. So, we're going in the right direction. Hopefully, as October numbers come out here, we'll see that trend continue as well. But again, unfortunately, with the government shutdown, we're still lagging in data, such as the case numbers and more of the real granular geographic data. However, with these rates continuing to push lower, we have been seeing these volumes begin to tick up in September. Again, like I said, hopefully we continue to see that trend as we go into October as well. But tune in next month to see what happened, and really hoping we start seeing some more data come in, and hopefully this government shutdown ends and we can get back to getting full data sets here. So we will talk to you next month.
A recent blog post from the law offices of Lori E. Ohal in Lithia, Florida caught my attention because it addresses how heirs can settle an estate when there's a property encumbered by a reverse mortgage, more specifically a home equity conversion mortgage, or HECM. I want to bring this to you so you can kind of get just a general idea, but there is a very important caveat at the end and a footnote that you're also going to want to take heed of. We'll get to that here in just a moment, but let's dive in. As reverse mortgage professionals watching right now know well that the heirs who inherit a property with a reverse mortgage are not personally responsible for the loan beyond the value of the home, and that protection exists because of the non-recourse clause. Even if the loan balance does exceed the home's market value, because of that non-recourse clause, then the heirs have no responsibility beyond the value of the home. So there's a number of ways they can settle that. We'll jump into that here just momentarily. But it says now the lender is notified when the last borrower has passed and the clock begins ticking. Ohal's specialty is estate planning. In other words, she helps families understand what happens to a reverse mortgage when the last borrower has passed and how to plan accordingly. And she lays out the basics. When you pass with a reverse mortgage, the heirs inherit both the property and the loan obligation, but that's up to a limit. They're not personally liable for any amount that exceeds the home's value, the non-recourse feature, which is not in place because of any FHA insurance premium paid. That protects the lenders, but it's there because it's contractually guaranteed in a home equity conversion mortgage loan note. When inheriting a home with a reverse mortgage, the heirs typically have several options, she says, when inheriting a reverse mortgage, but they have to make informed decisions, and I would say timely decisions as well. The first option is if the heirs choose to keep the property, they can pay off the reverse mortgage loan balance with the principal and accrued interest, and they can use their own funds or finance that with a traditional mortgage or other financing options. The second option is to sell the property. So if they can sell the property for more than what's owed on the reverse mortgage, then that remaining equity goes to the heirs. It does not stay with the lender. It goes to them, and they can do with that as they see fit or as the estate plan dictates. And the last option is one that I've seen personally come into my office, and that's when the balance of the reverse mortgage exceeds the home's value or market value at that time. And that's when you'll have the heirs walk into the office and sign what's called a deed in lieu of foreclosure, which basically says, hey, we don't want this property. You can go ahead and take it. This is an excellent point that she makes in this column, and she says the most important step that one can take is having open conversations with your family about your reverse mortgage. In other words, don't keep it secret from the adult children or heirs. It's going to be more of a burden that way. Many inheritance complications arise from a lack of communication rather than the loan itself. The heirs need time to prepare and understand their choices. It doesn't have to derail your legacy planning. With proper understanding and preparation, you can navigate the process smoothly while still benefiting from the financial security the loan provides during your lifetime. But if you really want to know how to settle a reverse mortgage, or you have clients with adult children, then I would strongly advise that you purchase the book Navigating Reverse from Dan Hultquist, one of our leading industry experts, and he really spells out the process. You can think of it as a user's manual for a reverse mortgage. And so understanding reverse really dives into topics such as this, which is what's necessary to pay off a HECM. There's just a wealth of knowledge at understandingreverse.com. So be sure to check that out. But again, at least this estate planning attorney is pointing to the importance of communication, and she does have a grasp on the basics of settling an estate, perhaps something you can share with your borrowers and their adult children.